Alrighty, I've had quite a few requests from students to give you guys a preparation video for the upcoming accounting SAC, so here we go. First off, I can't stress enough, task words. Make sure you know what to do when it's a state question, an explain question, a distinguish or a discuss. Every year I have students, for example, do a distinguish question, like distinguish between a period cost and a product cost. They define the two things for me, which is great, but they never tell me a point of difference, so they end up losing a mark. For a question like this, it's usually, 3 marks? So by losing one, they've effectively lost 30% of their marks right there in that one question. And you know, these sort of things add up. You make one mistake here, one mistake there. Next minute, you've only got 60% overall, or maybe 70% overall on your actual test. For little things that, you know, if you just take your time and refine it, you could easily get yourselves in the high 90% range. So yeah, discuss questions. Another one that gets butchered a lot by students. Whenever you see a discuss question, you need to tell us what is a positive aspect of what's going on there, and also a negative aspect of what's going on. And one that I haven't listed here is evaluate. It's just another step on top of a discuss. After you've been busy telling us what the positives and what the negatives are to whatever it may be, you just need to give us a conclusion on which side you choose and why over the other, obviously. Alright, so please understand those task words, because you'll see this a lot throughout the year in every subject. One last thing I could probably mention here is make sure you define or give us an understanding of each accounting term before you even go into answering the questions. The next tip, qualitative characteristics and accounting assumptions. You know, that beautiful stuff from chapter 1? Well, you'll see it again. You can't dodge this. It will be on every single SAC you ever sit, including the end of year exam. So there shouldn't be an excuse that you don't know these by now, because we're constantly pummeling you with these sort of questions. For example, here's one. Actually, I take that back. It's not an example. These are the qualitative characteristics straight from the study design. Memorize them. Don't be silly. These are easy marks to obtain. I know many students who could easily increase their scores by 10-15% if they just knew the definitions to these key terms. Same thing with the accounting assumptions. So let's do an example now. Explain how the use of inventory cards support relevance. So to get the 2 marks, define or show us an understanding of what relevance is. And then the last mark is linking how inventory cards support relevance. So here's an example for you of a suggested response. Now, I learnt this from a teacher a long time ago about this thing called signposting. Signposting is literally just breaking your answers into paragraphs to show the examiner where they can find their marks, or find the marks that they deserve to give you. So in this case there's 2 marks, so I broke it up into 2 paragraphs. Because you got to realize, guys, as an examiner or as a marker, they get tired. They're only human. If they keep reading people's responses and it's all clumped up and hard to find what they're looking for, they're most likely not going to give you the mark rather than give you the mark. So why not make their job easier in order to give you guys the best chance of getting the full marks you deserve? Yeah. Anyway, feel free to pause the video, read the response. It's always good to include an example. Generally, these questions are based on a case study, so there is an example in there. Try to use the question's scenario as your example. The accounting elements: assets, liabilities, owner's equity, revenue, expense. At this point in the year, you should know what they are, how to define each one. There shouldn't be any more excuses, because they do pop up on the test every now and then. Actually, they're quite common, if I'm being honest. So, for an example, you might get something about inventory write-downs and how it fulfills the definition of an expense. This should be an easy 2 marker that every student should be able to obtain. So, show us an understanding of what an expense is, and then link how inventory write-downs support the definition of an expense. That's all we're looking for. And here's a written response by me. Enjoy that. Feel free to pause the video and take a good read. Moving on. This is always butchered. the accounting equation. So whenever you hear the accounting equation, I want you to just think about what happens to the balance sheet after something occurs or a transaction occurs. So for example, what happens to the balance sheet after an inventory gain or loss occurs? Well, if you have an inventory loss, for example, we know that inventory goes down in assets. We know liabilities are not affected because there's no liabilities to be seen in this transaction. And we know that owner's equity goes down because an inventory loss is an expense, and the expense decreases owner's equity. Alright. Advertising. Similar sort of deal. Advertising causes a reduction in inventory, which is our asset. No impact to our liabilities, but it also increases our expense, which overall decreases our owner's equity. And inventory write-downs, another one, the same thing. Decreases assets via inventory, decreases owner's equity via inventory write-down expense. The only one that's different here is an inventory gain, which increases our assets and increases our owner's equity through an increase in revenues. Okay, so it's great that you can say that, you know, assets go down and owner's equity goes down, but be sure to tell us the specific accounts and the actual values of the change. Tell us the net change in assets, net change in owner's equity in this case. So, inventory cards. It's a popular topic. Students generally do really well in this section, but please make sure you know the difference between FIFO and identified cost. And also make sure you know how they differ when it comes to inventory returns. For example, with FIFO, when inventory is being returned to the business, you need to return it at the newest price before you work your way to the oldest price. And you need to keep note and understand how much inventory of that new priced item you have, because if you have a maximum of 10 ever in the inventory card, you can't all of a sudden have 11 or 12 of that new priced item. You have to cap out at what you originally had of the new item, then work your way backwards to the older inventory. Also, you need to know when best to use FIFO, when best to use identified cost. The best way I can explain this is FIFO is the lazy approach to doing accounting. It's quick, easy, but the con is it's not as accurate. Where identified cost is a very accurate representation of what's coming in and out of the business, so the reports will be fantastic. But the consequence of using identified cost is it's very time consuming. So when it comes to pointing out when to use which one and when, you have to figure out what is the nature of your inventory. For example, if you're selling loose screws at Bunnings and you got 10,000 Phillip head screws, there's no point in using identified costs, because a screw worth 1.5 cents versus one that's worth 1 cent or 1.2 cents, is it really going to matter when it's leaving the business? And do you have the time to individually barcode each individual screw to sort that out? No. So FIFO would work really well in that situation. But if you have very few units, such as, fridges. If you only have 10 fridges at a time, then you could easily just put a sticker or a post-it note or some sort of identifying mark to know what price is each of those 10 fridges. And then, you know, when you sell it, you can easily just go, alright, it's this price or it's that price, and put it into your books. So yes, in summary, identified cost when you have very few items and it's easy to distinguish. FIFO when there's just too much and it's going to take up too much of your time to do so, if you use the identified cost. What's the purpose of inventory cards? So besides finding losses and gains, you need to be able to tell me stuff like identifying fast and slow moving lines. So when it comes to recording inventory, you will see general journals and general ledgers again. Now, students usually struggle when it comes to doing this stuff, so it's imperative that you understand how to do your debits and credits and where does it go on the general ledger or journal when it comes, and what accounts when you're recording like inventory losses, gains, inventory write-down, sales of inventory, purchase of inventory, discounts, and also, what is there? Returns. My goodness, returns. I hate returns. Alright, you also need to know what product cost is and period cost and, you know, the difference between the two. Because you will get a line item. Oh, sorry, you'll get a source document. And it'll list out all these different prices. And you need to figure out what actually goes in as a product cost and what actually goes in as a period cost. Now, I'm not going to define each one right now. Yeah, this is just a refresher. This is not meant to be a full lesson, so please review this topic if you need it. So here's a question for you. So this is straight from, I think, last year's accounting exam or the year before. Oh wait, it's February 2021. So this is the year before that, so 2 years ago. This is the first question on the exam, and you know, usually they open up with a question based on Area Study 1. So this, I figured, will be good practice to show you what to expect in your upcoming SAC by your teachers. So here we got an inventory card. We're selling some large pots. The supplier was Gourmet Gardening. Cool. And they're using a FIFO approach. So 5 of Feb and 20 of Feb. We need to describe what's happened on the... We got a memo, E4. 3 units at 150, total of 450 leaving the business. So, what could be happening here? What is the transaction occurring on February 5? Now you gotta remember, it's a memo. Memos mean it's a miscellaneous transaction, so it's a non-cash transaction. And it's early in the period, so your best bet would be either 1, they donated some inventory for advertising, or 2, they've done a drawing. Now we can't really say it's a inventory write-down, because if you look carefully, we've actually removed some 150 units and we haven't actually devalued any of the inventory here. Also, another thing is, I'm not a big fan of inventory loss or gain in this particular response for this memo, because it's not at the end of the period, just to make sure all the reports are accurate before they write off. And then on 20th of Feb, what we got here, an EFT. Now, it could be either a cash sale or a cash purchase. But since it's in the out column, we know it's a cash sale. Because inventory is leaving the business, and the only reason inventory is leaving the business is if we sold something for cash. And then part B, explain 2 reasons why FIFO cost assigned method is used by this business. So, why are they using FIFO instead of identified costs? It's 4 marks. Alright, when it comes to FIFO, 2 reasons why you use it. Because it's hard to distinguish one item from another. And the second one is, it's very easy and quick to implement. It's not too time consuming. Those are your reasons behind FIFO. And don't forget to define what FIFO is. Show us an understanding of what FIFO is in order to get those 4 marks. So let's look at the answers. What did the state get for this particular question? Well, the first question, the average, wow, nearly about 23% of the state got 0 marks for this. Okay, that's quite baffling. So, it's listed right here. February 5, memo. These transactions could possibly be identified as drawings of inventory, advertising, and inventory loss. Well, there you go. Inventory loss is a potential answer, but as I said earlier, it's at the start of the period. Not very comfortable with that. Next, we got here for the 20th of Feb. Was identified using a source document EFT, blah blah blah. The only acceptable response was the cash sale of 5 large pots. So there you go. So, moving on. Alright, next bit. So, underneath the inventory card, they told us the color of the 7 remaining large pots have faded badly. The owner decided that these pots would be discounted to a price of $100 each, plus GST, at the end of February. A watering can costs $10 plus GST and would be given away with every large pot sold. Free delivery of these 7 pots would cost Garden Leaf a total of $105. Pardon me. So calculate the total value of large pots at 28th of February after applying the lower of cost and net realizable value rule. Alright, so how much do we have left? Well, on the 20th of Feb, we only have 7 at 160. So now that they're worth $100 each, we have to discount them by $60 each. But we just need to figure out what the total value of the inventory is using lower of cost and net realizable value. Now, it might seem straightforward to just go, oh yeah, it's $100 each now, and it used to be 160. So just do 100 times 7 and $700. That's our new inventory price. But you'll be incorrect. Remember, net realizable value is estimated selling price less any costs associated with getting the goods ready for sale. So in this case, they would have to, when they're selling each pot, they would have to give away a watering can with it, and each watering can is $10. Another thing, the delivery of these 7 pots will cost $105. Could $105 easily be divided by 7 units? Yes, it can. 105 divided by 7 is $15. So it'll be your estimated cost of getting goods ready for sale is the 15 and the 10, so $25. So 100 take away 25 is $75, and I'm hoping that's what the cost of the inventory, each inventory is. So 7 times 75 is what? 7 times 75 gives us 525. I hope that's the answer. Oh, thank God. Alright, I still know my accounting stuff. Next. Recording the necessary adjustments in the inventory card. So we know that they used to be 160 and now they're worth $75 each. So, what's the difference between 160 and 75? Well, let me get a calculator for you. Don't know why I didn't use this earlier. 160 take away 75 gives us $85. So we're reducing, so it's 7 times 85 equals 595. So in the out column you should have 7 at 85 for a total of 595, and in the balance should be now 7 at 75, and 7 times 75 is 525. Let's take a look. And there you have it, right at the bottom here. Alrighty. Whew. Alright. So E, F, G, and H, let's go through it. With reference to 1 qualitative characteristics, explain the importance of recording from source documents. Ah, classic. This is what I mean. Chapter 1 will always follow you. So using 1 qualitative characteristic, explain the importance of recording from the source document. So it's worth 3 marks. How do you get those marks? Well, your first mark is identifying which qualitative characteristic it is. Your second mark is defining that qualitative characteristic. And your third mark is linking how that qualitative characteristics explain the importance of recording from source documents. Alright? I'm not going to tell you the answer, we're going to look at it in a moment, but that's the framework to properly writing a response for that question. F, calculate the cost price of 1 medium pot. How are you going to calculate the cost price of 1 medium pot? Well, they tell us they're $110 each, and it's 1,100, and there's cartage in. Now this cartage, are we able to easily, on a logical basis, divide that per unit? Yes, because it's only one type of pot. So 150 divided by 10 gives you 15. So you can easily divide that cartage in per unit. So your answer should be 110 plus 115, which is $125 per pot. For G, justify your treatment of the cartage in. 2 marks. First, you get, well, I already answered this in part F. You get your first mark by defining what product cost is. And then your second mark is explaining or justifying, well, telling us why cartage in fulfills the definition of a product cost. H. On March 6th, Garden Leaf paid invoice 215 with check 381. Prepare a general journal entry to record that payment. So, you need to be able to tell me how you record this transaction in the general journal. Now, some easy mistakes that I usually make when it comes to this. And the only reason why I'm pointing this out because I remember doing this test the year it came out, about half an hour after my students, and just kicking myself for losing 5% on this exam because I forgot to read the terms of the invoice. So here, 4 by 7 or M by 30, meaning there's a 4% discount if you pay within 7 days, and you got 30 days to pay it off with no discount after 7 days. So, when was this sent out? The 3rd of March. When did I pay it? The 6th of March. That's within 3 days. So we do get that 4% discount. So, you need to have a debit entry for accounts payable, and you're gonna need a credit entry for discount revenue and accounts. So, discount revenue and bank as your credit. So let's take a look at the answers. Well, the importance is that source documents, are free from material error and bias, and everyone draws from the same conclusion. Therefore, you can trust that the information provided will be correct. Well, that's where I would have gone with it. Alright, moving on. F. So, one medium pot is $125. As I said before, each pot is 110. The cartage in can easily be divided per unit. So 150 divided by 10 is 15. 15 plus 110 gives you 125, which is the answer. So G, you have to explain why you did cartage in as a product cost. That's assuming you did part F correct. So here, all they say is cost incurred in order to get the inventory into a location for sale that could be logically allocated to each individual pot. So just another thing to mention here, sometimes you will get a cartage in that is easily divisible per unit, but it might be an insignificant amount to influence decision making. So when it is an insignificant amount, let's just say it's in cents or it's less than 5% of the total cost of the inventory, then you can write it off as a period cost. Just keep that in mind because it can occur. It's very rare, but if I was writing the exam, I would totally screw you guys over by putting that as a question. And as you can see here, 20% of the state couldn't even answer G. So please don't be one of those unlucky people. So in order to get the full marks, all you have to do here for G is define what product cost is and then just explain or justify why the cartage in is able to be written off or added into the cost of inventory due to it being a product cost. And then H, when it comes to recording the payment of the invoice, remember there was a discount involved. So as I said earlier, your debits accounts payable and your credits is discount revenue and bank or cash at bank. Is there anything else I need to tell you for the upcoming SAC? Not sure. I did forget to mention a narration. Now, when it comes to narrations, you just need to put enough information there so it fills the void that looking at the debits and credits can't tell us. So, looking at this, all they say was we're paying Gourmet Gardening in full, allowing for a discount of $55. Well, paint the full picture. You could have easily just written settlement of account owing to Gourmet Gardening and just put the check there and you're done. You don't really need to say allowing for a discount $55 because you could see there discount revenues credit $55. No, that's just my opinion. But, this is what VCAR have cited as a suggested solution, so you're probably better off trusting them than me, in all honesty. Alrighty, coming towards the end now, inventory turnovers. Make sure you know this stuff. Make sure you know the formula. Yeah, I know you're not going to be, calculating what inventory turnover is. The percentages are usually given to you on the SACs and on the exam, but by understanding the formula, you've got your factors to explain why it's the value it is. And by understanding the factors behind it, you can use those factors to explain how they can repair the inventory turnover to be better than what it currently is, or to... Actually, no, that's as far as I need to say. To make it better than it currently is, or explain why it's better than it currently is. That's what I was trying to say. So, benchmarks. What sort of benchmarks can we use to determine if inventory turnover is good or bad? I mean, if you got a number 50, without any benchmarks, we don't know if it's good or bad. So, the three that you always refer back to is previous performance, budgeted performance, and also... what's the last one? Previous performance, budgeted performance, and industry averages or businesses of a similar nature. What are they achieving? Can't believe I went blank for a second. Anyway, that's all I have. If you have any questions, feel free to write a comment on this video and I'll reply back to you. You guys have my email address also, so you're more than welcome to contact me. Best of luck for the SAC, and all the best. See ya.